please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Our market master for the day, Vetri Subramaniam, now joins us, Group President and Head of Equity at UTI AMC. Vetri, good morning. Good to have you on the show. Fund managers feeling a bit more relieved now than they were, say, 2 months back. The market's rally this time has been slightly more broad-based.
Yeah, I'd say, compared to a month ago, it's certainly become a lot more broad-based, but it's been a bit of a narrow market for, I'd say, pretty much year to date. So those challenges, in a sense, sort of continue. But, it's been a nice, good rally over the last year, year and a half, very strong rally over the previous 5 years. So, fund management is always a challenge. I cannot quite recollect when it has not been a challenge.
Okay. Good morning, Vetri. But is it a little, do you feel nervous buying over here? Valuations, people tell us, are at a 20% premium to the average, long-term average.
Yeah, Lata, I think as far as, valuations are concerned, that's been a challenge. It's been a challenge in the past as well. I think in the last 2-3 years, it's always tended to trade at a significant premium to the long-term average. And there have been only a few cuts, few and far between, where you've managed to sort of get in at slightly healthier levels. So it's been a bit of a challenging market, but, that's also, I think, reflected in the fact. And if I were to just pick a point, and you could accuse me of being, using only selective data points, but if I go back to, let's say, March of 2015, where the market sort of went up to almost 25 odd times on a trailing earnings, we're now, of course, even higher than that. And if you look at what's happened to the Nifty from March 15 to today, then the CAGR is something like about 7 or 8%, which is, nothing great. But at the same time, it just, sets you up or gives you a perspective on the fact that when the market is pricey, you have to sort of be a little bit more careful about your return expectations from the asset class. Obviously, to the extent that we run equity funds, the funds we run are pretty much fully invested. There are only 1 or 2 strategies where we, have our own internal asset allocation models, which guide us in terms of what equity allocation we would like to have. And as far as those products are concerned, we've been continuously reducing asset allocation. So, in our multi-asset hybrid fund, we've been continuously reducing our equity allocation, largely driven by valuation concerns.
Okay, so you're reducing equity allocations because of valuation concerns. Vetri, hi, good morning. Thanks as always for joining us. There are many macro headwinds that we're dealing with right now, whether it's higher crude prices, a rising fiscal deficit, a weaker rupee. Do you see these issues drag the markets down in the near term, or do you think that the market will continue to climb these walls of worry?
Well, I mean, given the background of what's happened over the last 1 year, I'm not sure I'm well qualified to answer that. If we'd had this conversation a year ago and we'd thought up a scenario in which the currency would fall by 10%, bonds would see yields go up by 150 basis points, the current account deficit would start to get close to a 3% run rate, and oil prices would be up, whatever, 40 odd percent, though I'm not a great fan of what oil prices do. Our base case then would not have been that over the last 1 year, the market would be up 18%. So I would actually submit to you that we've already been climbing a wall of worry quite well over the last 1 year. It could well persist, I don't know. But that just tells you that, sometimes these correlations are important, but at times, the causation is not always very clear to us. Okay. So could it continue to behave the way it is in spite of these factors? Who knows?
Okay. I can't remember who could have put this irony so beautifully, Vetri, the way you wrapped it up.
Okay. Vetri, so from your point of view, what could be the trigger for this market to head lower? Because so much bad news been thrown at the market. I mean, this morning, for example, we're talking about rupee where it is and crude where it is. There's been, of course, state elections around the corner. There's been some global uncertainty, but the market just keeps inching higher. So what do you think could be a trigger for a possible correction for market?
Hard to say, Anuj, and these things are never clear ahead of time. I don't think anybody could go back and clearly point to the risk factor which was completely visible either in 2007, 2008, or for that matter, even if you take the small correction that we got in 2015-16, where the market dropped almost about 22-24%. I don't think you could really go back to 2015 and be able to pinpoint precise what it was that caused the market to then drop 20% over the next 9-10 months. So these things are virtually impossible to predict, and I think the nature of the beast is such that very often the things that we discuss the most sort of tend to get discounted into the price, whereas it's the unexpected that is in nobody's thought process. It's the things that we don't know which actually end up doing the damage. So we don't know where that is at this point of time, but if you do believe that valuations give you a good reasonable roadmap of how to deal with risk, then effectively what the valuations are telling you is that you're not really being adequately compensated in terms of valuations for taking the risk in equities at this point of time, or at least being hyper aggressive about equities at this point of time.
Okay. So have you made up your mind? Are markets a puzzle or a mystery? I saw that in your tweet.
No, I think it is always a mystery, and the simple reason for that is you actually don't know what are all the factors which cause the outcome, and there can be multiple outcomes, whereas with a puzzle it all eventually falls in place, but with the market it's always an unknown.
Okay. Well, that was just on the lighter note, but Vetri, let me come to sectors. The much prized, much valued private sector retail banks are now not the best performers. We have seen money shift to the private sector, generally to the corporate lenders. Do you see more of that trend happening? That you may see, not exactly false, but underperformance in the retail banks and outperformance in the corporate lenders. Is this trend to continue?
Well, Lata, you should always be a bit careful about, reading too much into what's happened over 3 months or 6 months. There's been huge outperformance by these retail banks over the last 3 years or 5 years. But I am sympathetic to the idea, and you will see this in at least some of the portfolios that I run, where increasingly we are getting a lot more comfort with some of the corporate-oriented banks. We do think that, the worst of the asset side deterioration is now behind them. It's been well recognized. It's been well telegraphed to the market. As far as P&L recognition is concerned, there could still be a few speed bumps along the road, but that's only the recognition in the P&L. The balance sheet damage is already now well known, well captured. So we would tend to believe that, going forward, you should start to see much better sort of performance from some of the corporate oriented banks, simply because in their P&L, there is a very strong case to be made that the credit cost can actually drop quite significantly over the next few years. Having said that, I would still reiterate that whichever bank or financial institution you are looking at, the two things that become very important is the quality of their liability franchise and the strength of their capital adequacy, because that is what will allow them to grow over the next few years. And if there is any weakness on these two parameters, then it becomes not so attractive. So it's not as simple as saying all corporate banks are buys, but if you've got corporate banks where the capital adequacy is healthy, they can continue to go for growth, and the liability franchise is good, then certainly it might be something to look at.
Okay, so you're feeling comfortable about some of these corporate lenders. Are you also feeling comfortable to increase exposure in the pharmaceutical space, Vetri? A lot of companies talk about the worst of the pricing pressure being behind them, but that's something they've been saying for many quarters now. Stocks have run up though. What's your own view here?
A good question, Sonia. I would just say, there's a disproportionate amount of focus when it comes to pharma, to people just looking at what's happening in the US generics market. Keep in mind that the US generics market, based on the company we are discussing, could be anywhere between, 10% of profits to maybe 35-40% of profits. So there's a big chunk of profitability that comes from India, that comes from emerging markets. And I think the Indian market opportunity continues to be quite robust. It's growing well. The sad part is that, as societies evolve, as income levels go up and unfortunately pollution levels and stress levels go up, people tend to fall sick a lot more with chronic conditions, and it may not be good for all of us as a collective, but it's good for these pharmaceutical companies that produce the drugs that meet those patients' needs. So I think there's a good strong domestic franchise for some of them. I think a lot of the pain in the US is now already in the numbers, and when we look at valuations, this is one of the few sectors which increasingly starts to stand out in terms of the fact that it's been derated quite significantly, and we do get some comfort from the valuations. They certainly need to pick up their return on capital metrics. Some of them have seen significant destruction, but keep in mind that they're also spending very aggressively on their portfolio of complex and specialty products, almost 6 to 7% of revenue, and maybe the payback on that is not yet in the numbers. So there is scope for return on capital to improve as well. So we are incrementally quite positive on that area, but you need to pick and choose the companies. The winners in the next upturn in pharma may not be the same as those we've known to do well in the past.
Actually, I wanted to extend the same question, but on a slightly larger note, Vetri. The new normal for FY 2018 looks like a rupee that has slid and could slide more, and yields that will be closer to 8% compared to an average of probably 7 to 7.5% last year. So how does that change your portfolio rejig?
So Lata, I've learned the hard way over a very long time that you can't really keep trying to rejig your portfolio too much to try and sort of reflect what might be the current macroeconomic trends, and you sort of back companies to deal with the macroeconomic challenges rather than try and continuously reposition your portfolio. So I'm not a great one to sort of continuously rejig portfolio, but the operating mantra for me, not just today, but for the last, I would say, 3-4 years has been that we want to be invested in companies that have got, reasonably strong cash flows, balance sheets, and perhaps are in a situation where they can grow through the next growth upcycle that the country witnesses, rather than be invested in companies that are still trying to address their internal issues, have poor cash flows and weak balance sheets. So I think the strong will just get stronger through the next cycle, and if you're able to get them at reasonable valuations, then that's what makes them attractive. So I would say that is the underlying thought process, and trying to change portfolios too much based on short-term tactical considerations, even more so macro considerations, is actually fraught with a great degree of risk.
Right, Vetri, we'll leave it there. Thanks a lot for joining us. The market's breaking out, by the way. Just look at that. The Nifty is up 45 points.